I love when the plan comes together.
All right, Scott, you want to kick us off?
Sure, thank you. Appreciate it. Well, thank you all for having us. We do appreciate this opportunity. We're it's like everybody else, doing the best job we can, trying to keep up what's going on. This is it's been a busy year, and it doesn't look like it's going to get any easier. So this is our safe harbor, and by that we mean we're not in the business of giving tax advice. We're in the business of helping people automate their tax compliance, which is a variety of things that goes along with tax compliance, and we're happy to help you where we can, but there's things that we just can't do. So I hope you understand. Okay, I'm Scott. I do government relations for Avalara. I come to Avalara from the government side of the world, where I've had a variety of jobs in different types of governments doing tax compliance, tax administration, tax policy. Thomas?
Thanks, Scott. I'm part of the dedicated Infor team here at Avalara. So this will be my 4th year here. And before I joined Avalara, I actually spent the previous 7 years with Infor. So my role is really to help onboard new clients, guide them through the evaluation process, see if a partnership makes sense. So glad to be here. Thank you again to Shane and Central Data, as always, to let us speak to your clients.
Okay, so what we're going to talk about today, a little bit about recent trends and changes, some tariff compliance stuff, economic nexus thresholds, excuse me, some top state changes in 2025. This has been almost an oddly busy year in state tax compliance, in addition to the international stuff that we've been dealing with. Some conversation about retail delivery fees. This is an area that is of retailing that has become exceptionally complicated, and it gets talked about a lot. So we want to make sure you understand that. And then we'll talk a little bit about why we might be a good fit for you. Okay, this is a busy slide, and it's busy for a variety of reasons. And I want to take a moment to, I wish I could see the darn thing. That's not helpful. I just messed things up. Sorry about that, folks. Honestly, I can't even read my own damn slide. 11 states plan to reduce income tax. This is a theme that's been going on for, oh geez, 8 years. Every state that has an income tax thinks they would be Florida if they got rid of their income tax. If you read what the last governor of West Virginia, who's now U.S. Senator of West Virginia, said throughout the whole time he was governor of West Virginia, the only reason West Virginia is not Florida is because Florida doesn't have an income tax. Everybody that's going to Florida from the Northeast drives right through West Virginia. They would certainly stop and stay in West Virginia if West Virginia didn't have an income tax. That concept is believed by a lot of governors, specifically around the country. Governor of Mississippi just made that same exact speech last week when he signed legislation that he believes will eventually eliminate the personal and corporate income tax in Mississippi. The most hated tax on the planet is the property tax. And when states aren't talking about getting rid of their income taxes, they're trying to figure out a way of minimizing their property taxes. Governor of Florida just announced 2 weeks ago, maybe 3 weeks ago, that he would like the state to explore the possibility of eliminating property tax in Florida. And that's not an unusual thing for a governor to say, except in a state where they don't have an income tax. So he would be dependent upon his sales tax and have corporate income tax to fund 100% of the cost of government in Florida, which is much more than what the state of Florida currently pays today, because most of the property taxes go to local governments. Personal property taxes are they're a variation on the theme. Not every state has a personal property. It has a tax on personal property. The personal property would be like a laptop, a wedding ring, a cow, a piece of farm equipment. A number of states have repealed them or are working on trying to get it repealed, but there's still a lot that have it. And it's a tax that goes along with the property tax. Philosophically, there's three types of property. There's real, personal, and intangible. And in the beginning of the property tax, states always taxed real and personal, harder to tax intangible. But there's been many attempts at doing it. But over the years, at the request of the business community, some states have moved away from taxing personal property because it's a tax on inventory. So it's a tax on livestock. If you're a farmer, you get to pay property tax on your cows in addition to paying property tax on your property. 6 states have no individual income tax and rely heavily on sales tax. Florida, Texas, Tennessee, which is where I live, South Dakota, Wyoming, Alaska. Those states all have one thing in common. Either they're very poor, like South Dakota, or they have lots of oil wealth, like Texas. And you can do it either way. It's really hard if you have to do it without the oil. Services is taxing services is a conversation that, at least in the last 8 or 9 years, is gone in conjunction with the conversation about how to get rid of your property tax or your income tax. And the states that don't tax services, and the majority of states tax none or a very limited number of services, believe that this is an area that their tax structure is lacking, and they should be finding a way to get that tax. It's honestly not much more difficult than taxing property. I'm originally from South Dakota. I ran the sales tax in South Dakota for 10 years. South Dakota taxes everything. And so I tax lawyers just like I taxed Walmart. Lawyers charge a fee, provide a service to somebody, charge a fee, add sales tax. Walmart sells you something, charge sales tax. Same concept. A little funkier doing the lawyers, but not that much funkier. There's been very little change in what services have been taxed over the years. Kentucky and Iowa are the very few, maybe the only 2 states in the last 8 years that have actually made a significant change and started to tax more and more services. The 4 states that tax them by default are West Virginia, South Dakota, New Mexico, and Hawaii. Those 4 have taxed them by default for 50 years. Almost no one has changed anything in that 50-year period other than what Iowa did and Kentucky did 4 years ago. And they just, they're inching toward taxing more and more services. It gets talked about a lot, an awful lot. Every governor that knows they need to raise money to get rid of some of the tax knows that there is tax that could be collected if they figured out a way of taxing services. But rarely is somebody successful doing it. As I said, most tax some, but some tax very little. Colorado taxes almost none. California taxes almost none. North Dakota taxes almost none. 24 states are a member of the streamlined sales tax. Streamlined sales tax is a multi-state, multi-year, multi-industry attempt at making sales tax compliance easier for retailers by making it simple or uniform. I was one of the founding members of the streamlined sales tax, and our goal at the time was to make a radically simpler sales tax system, which we could have very easily designed, but no one have ever adopted. So instead, we looked at the existing system and said, okay, what's wrong with the existing system that we can actually fix? And this is their 20, actually, I think last month was the 25th anniversary of the streamlined sales tax. It is the longest running, most successful business tax simplification initiative in the United States history. No one has ever done it for this long. No one's ever done it with such success, and still the sales tax is still radically complicated. One of the things that organization does, though, that's valuable is they realized, I was part of this group, we realized right off the bat that there were some things we would never be able to make simple. Or even if we can make it simple, we can never eliminate it. And that's when we decided that honestly, the best approach for the government is to craft a way for retailers to get out of the business. So we created it. I keep saying they, it was me, I was there. We created this thing called a certified service provider, which is a public-private partnership whereby the government certifies the software and services provided by private companies to provide sales tax compliance service to retailers and then to pay for it. Avalara was the very first certified service provider. We are the biggest certified service provider. And our role is to provide sales tax compliance services and software to retailers around the world in these 24 states, and those 24 states pay us instead of the retailer having to do it. Honestly, it's an amazing program in that if someone takes advantage of it, qualifies, and it takes advantage of it, there is very little that business has to do in the way of tax compliance from that moment on. 30,000 retailers have registered. I mean, so it's a big deal. There's a lot of folks that are out there taking advantage of what these 24 states have done, and it's an enormous benefit for everybody, because that's 30,000 retailer states don't have to audit, because they've audited the company that's providing the tax calculation that is where the lion's share of errors come in. And just to services, and talk a little bit more about services. The definition of sales price that almost every state uses is virtually identical, and it is intended to apply to anything that is sold by a person and anything associated with that sale. So the number one service that's taxed around the United States is transportation. Services associated with completion of a sale. So I sell you a pair of shoes and I ship them to your house, and I charge you, for the shoes and the shipping and handling. Nearly every state taxes the shipping and handling along with the shoes. It's just standard. That's the number one services tax around the United States. Otherwise, it's amusement and recreation, concerts, television, some personal services, but a lot fewer personal services than probably should be taxed. It's shocking how few tax haircuts. That's, if you're going to tax the consumer on a consumption of something that they consume, a haircut would be a natural thing for somebody to tax. Very few do it. On the other side, where they do tax more, is services sold to businesses. Avalara, for example, we are a B2B company. We provide services only to businesses, and it's shocking how many states tax our service that don't tax haircuts. To me, it's completely illogical, and I've never quite understood how my friends in tax administration and tax policy could get it so wrong. Oh, retailing. 1 in 4 U.S. jobs, $5 trillion U.S. annual GDP. Honestly, retailing is our gross domestic product. It is the thing that our spending is what drives our gross domestic product. So things that impact our ability to spend, or our ability to spend it in and of itself, our choices to spend, are the things that affect whether or not our economy is growing or not growing. One of the things that makes that complicated is the sales tax. Let's see, what do we have? We have 45 states plus the District of Columbia, Puerto Rico, and the 110 cities in Alaska that have a sales tax. Every state has a lodging tax. Every state taxes communication services. Every state taxes alcoholic beverages. Every state taxes tobacco. So while there's 45 states that say they have a sales tax, every other state has a tax that walks and talks like a sales tax. It's just very product specific. In addition to that, there's 13,000 local governments in the United States that have a sales tax. The vast majority of them are cities, and those cities change. There's a number of places in the country where there's a limit on, that's not true. In every state in the country that allows its local governments to have a sales tax, they put a cap on how much they can have. And in many places, those cities are capped out. So if they're allowed to have 2%, they've got it already, and they've had it for years. What they do, though, that is every bit as complicated, even though they can't change their rates, they change their boundaries. It is remarkable how many of those 13,000 local governments that have a sales tax change their boundaries every month. And if you're not keeping up with the boundary changes, you're not going to be applying that city sales tax to the latest group of people who were just annexed inside that city. And to do that, you have to have a very robust way of identifying where those people are located. Too many folks rely on 5-digit zip codes to get this done, and 5-digit zip codes is a horrible way of doing sales tax compliance. There are 39 sales tax holidays across 19 states in 2024, and that doesn't include Canada. Canada had a nationwide sales tax, started I think on the 15th of December and went through like the 15th of February, somewhere. It was a 3 or 4 month period. But otherwise, there's these 39 sales tax holidays that retailers have to keep up with. And there's a lot of commonality among the 39. You know, almost all of them have a back to school holiday. The back to school holidays are almost always in August. Florida is an exception. They have one in August and in January. And for the most part, they exempt the same things. Matter of fact, the 24 states that are members of the streamlined sales tax, they're required to exempt the same things. And the rest of them that aren't, even the ones that are outside of streamlined sales tax, they get pretty darn close to that definition of what's inside streamlined sales tax. But there's all kinds of things, and there's thresholds. So just about every state exempts something up to some amount. If you can look at the Freedom sales tax holiday in Florida, the one that runs in the summer, they exempt several hundred different items from sales tax during that holiday, and every one of them is related to your ability to go outside and enjoy the weather in Florida in summer. Every one of them has a threshold. They exempt canoes up to $500. They exempt paddles up to $75. They exempt life jackets up to $45. So if you're a retailer, A, you have to know what's exempt. B, you have to know when to charge or not charge that tax based upon the threshold that the Florida legislature put in place for that specific product. It's extremely specific. And they're also a state that has a holiday. They have a holiday on tools that you know, if you're a contractor. No other state has that. So all of a sudden, you're a retailer of construction tools, and you got to have your system structured so that you can exempt hammers and saws and nails in Florida for a 2-week period that you don't have to have anywhere else in the United States. This is an industry that where everything they've sold is taxable. One of the very few areas in retailing that is universal around the United States. Construction equipment is taxable, period, except in Florida during a 2-week period. So you're a retailer, you got to have this whole thing reconfigured so you can exempt the same thing in Florida that's otherwise taxable everywhere in the United States. 98,000 sales tax holiday rules. It's insane. It's hard to even imagine how many ways that the states have done this, and they allow their local governments to do it differently, which is another crazy thing. Thomas, who's doing tariffs? Is that you or me?
That's you.
Thank you very much. Appreciate it. Okay, so today's Liberation Day, or yesterday's Liberation Day, and you've paid attention to the changes that the president announced. And there's lots of conversations, and don't look at your 401k today. Don't do it. Don't do it. I did. Don't do it. We'll see. But all the things that make sales tax compliance complicated in the United States exist throughout the world if you're doing business throughout the world. A lot of places in the world, in-country compliance is relatively simple. That they all had value-added taxes, which is a very different tax from a sales tax. But it's still, but it's a national tax. There aren't local taxes you have to worry about, and so you only have to file one return with one government. And what makes that tax structure complicated is that the value-added tax requires a return every time there's a transaction. So every time there is a transaction in the life cycle of a product, there's a return that has to go along with that. And so if you're only doing business in, like the United States, if you're only doing business in one state, it's not that complicated. If you're only doing business in one country outside the United States, it's not that complicated. But most people do business everywhere. And when you do business everywhere, you expose yourself to all of the different things that those governments impose. And tariffs are just one of them. There's duties, and there's a thing called a HS, Harmonized System Classification Code. I think that's right. In the way this countries, and some of this is going to be involved in the tariffs that the president has imposed on automobile parts, is that to get the duty and the tariffs correct, the government's been extremely specific on how they apply it. Many instances where the amount of cotton that's in a t-shirt changes the tariff, not the tariff, but the duty that's imposed upon that thing when you import it into a country. The amount of leather, the type of leather, where the cotton was grown, the amount of aluminum, the amount of steel, all those things, countries around the world in some way, some odd way of trying to protect their own industries, have created these duties and tariffs such that it is extremely complicated to get these right. And they're an obligation. You can't ship your stuff into a country unless you've got that right. And if you make a mistake, they audit the customs agencies around the world. They audit importers, and the importers end up owing tax and duties, the value-added tax, additional duties, and sometimes penalties if they don't get those either of them right. Once in a while, your stuff never makes it through customs because you didn't do it right in the first place. There's been many instances where stuff gets delivered to a consumer, the tariff's right, the duty's right, the value-added tax wasn't collected, and it gets delivered to the consumer, and the person who's doing the delivery says, "Oh, and by the way, you owe me 13 pounds because the UK imposed a value-added tax on this," and the consumer says, "No, I paid for that. So I'm just going to go back and get my money back, and you can do whatever you want to do with that package. I'm not paying you the 13 pounds. Warehouses full of stuff that the shipping companies accumulate over months and months of time of failed deliveries. It's painful. All these things you have to be able to do if you're going to ship internationally, and you have to get it right. Otherwise, you expose yourself to the possibility of your products never making it to your customers, products getting to your customers, and your customers saying no, or you're being audited by a customs agency who says, "Nice try, but not good enough," and they impose a penalty plus whatever tax or tariff you didn't get right. HS codes, that was what I was trying to say earlier. Actually, I had a demonstration of that last week. It's fascinating how we assign these HS codes. They're often here's an example of it. So this is, okay, pair of shoes, pair of sandals. Pair of sandals, the universal 6-digit code is 6405.90. The blue letters, or the blue numbers, is for this country-specific codes. So if a country wants to put them in there, and most of them do, that's where they do it. So that pair of sandals, to a 5% duty in Australia, and their country code is a 6405.90.0001, and then the US is 12.5. Japan is 30%. Each one of them has a different duty tariff, HS code that's country specific. You have to be able to apply that to the product when that product is imported into that country, because that's how you classify. That's how it's going to be viewed by the customs. That's how they calculate the duties and the tariffs on that product. And this has to be done before the product is imported inside the United States, most likely after the sale and before the product is shipped into the country. And because you want this, if you're a smart retailer, you don't want to pay your customers taxes. You want to charge your customer your customers their taxes. And so this is the kind of stuff that you want to get right at the time of sale or instantly after the time of sale, so that when you bill your customers, it includes the price of the goods, the price of the shipping, and the taxes and duties and tariffs that go along with that product. So what do we do? So I think about what do we do? We try to do all this stuff, but what it's, and I told you, abandoned carts. People stop. What do you mean? There's a when I did the search on your product, it was $375. When I check out, it's $425. What's the difference? I get shipping, but what's this duty and tariff stuff? So people quit. Things get stuck in customs. The shipping company ends up taking these things back, because often the retailer says, it's not worth, you just keep it, shipping company. It's not worth you sending it back to me. It costs me more money to take that back and put it back in the inventory. You just keep it. Wrong HS codes get you in audit trouble. And then you have customers that don't shop from you anymore, which is what all of us are trying to avoid, is having a retailing system that is close to flawless as possible and as close to transparent as possible, so that your customers understand that when they click that buy button, that they're going to owe you $375 for that product, plus $50 in value-added tax or sales tax, plus the tariff and the duties. So, Thomas, I'm going to switch over and let you talk about economic nexus.
All right.
And I will drive the slides.
Sounds good. Thanks, Scott. Like Scott said, I'll take a minute to speak about economic nexus and just some considerations to take into effect. Quick fact, as you can see here, sales tax on average makes up almost 30% of state revenues. And so Scott touched on something earlier that's important, is states are starting to reduce or eliminate altogether their income tax, reduce property tax. And so what that's going to translate to is states looking elsewhere to fund their operations, to generate more revenue. Scott, next slide. So what that's going to result in is increases in state audits. And so that translates to states hiring more auditors. They're going to start employing things like AI and data mining. They'll share information with other states to target businesses to audit. They're going to increase out-of-state audits as well, not just looking within their own state. They're going to be looking at states outside that are doing business, shipping goods into their states. You can see at the bottom right too, they're even encouraging whistleblowing, disgruntled former employees. So this is going to become a bigger and bigger issue for remote sellers in particular, as those income taxes, property taxes are reduced, and they're trying to increase that sales tax revenue. Next slide, Scott. So one of the key areas, especially in the distribution space, is to understand your company's nexus, particularly economic nexus. Distributors, you're shipping all over the country. And as you can see on this map, different states have different standards and thresholds for determining whether or not you have a registration, reporting, and filing obligation within that state. You can see some states, a typical rule of thumb is, did you do over $100,000 of business into any state over the span of a year? That's kind of a good starting point, but you can see some have a $250,000 threshold. Texas, California, New York, they're 500. Some just count as few as 200 transactions to customers within their state as a nexus triggering activity. Scott, next slide. It's not quite that simple though. As a distributor, probably one of the things you're thinking is, well, we don't charge sales tax, so we don't have any sales tax obligation. A lot of these states, in fact, I think the number's 39, they count exempt sales or gross sales against their economic nexus thresholds. So even though you don't have necessarily a tax collection and remittance obligation, you still have that reporting obligation. And what that's going to mean is some other areas of sales tax compliance, maybe not the tax collection and correct rates, but the exemption certificate management process is what's going to be of the utmost importance. Next slide. So just to reiterate, as your business grows, the complexity grows, the tax risk increases. So we touched on Nexus. new geographies? Is your obligation expanding into new states? That creates new complexity, more work. How are you going to address that? New sales channels. Certainly coming out of COVID, a lot of businesses needed to find a new source of revenue, and a lot went to e-commerce. If you are considering or have recently launched an e-commerce platform, having a conversation about your sales tax compliance profile, your nexus profile, really is of the utmost importance. If you haven't been tracking the fact that your exempt sales may have triggered economic nexus, you could potentially be growing a tax liability in some of these states that you're not currently registered in. Having multiple technologies always creates some complexity. Even the use tax, do you have giveaways? Do you purchase goods that weren't taxed by your vendor that you use in your business process? Things along those lines. That can have a tax requirement in some states as well. Next slide. So I'll touch on the exemption certificates. Again, with the complexities of Nexus, understanding your Nexus profile, having your exemption certificate process in place is going to be of the utmost importance. So missing documentation or even just incorrect or invalid documentation can result in fines and penalties, unpaid taxes potentially in the event of an audit. Just an example here, imagine a company with a total revenue of $10 million, 90% sales or tax exempt. If an auditor finds a 30% error rate, which the typical error rate we find with our managed services team that does a review of our clients' exemption certificates, if an auditor finds a 30% error rate in their exemption certificates that they review, they'll multiply or extrapolate that error rate over a period of time. So at a rate of say 8.25% sales tax, a business could potentially owe over $227,000 in sales tax. That doesn't necessarily include fines and penalties. So all distributors must deal with exemption certificates, sales tax exemptions, and this is a big focus. Next slide. Similar example, just to run through this, same similar example. Imagine your business is being audited. The auditor reviews a 1-month sample for an audit period of 36 months, and they find one $15,000 sale with a missing or invalid certificate. So say that sales tax rate's 8%, that's a $1,200 uncollected tax amount. And the auditor is going to assume this amount of uncollected tax for each month during that audit period, which results in an uncollected tax fine of $1,200 times 36 months, or potentially $43,000. And again, that doesn't necessarily include audit penalties and fees. So just that one missing certificate could result in a cost of $43,000 to a business. So thankfully, Avalara to the rescue. We do have a solution called ECM, our exemption certificate management solution, that helps businesses streamline this entire process from capturing new exemptions or updated exemption certificates, storage of those certificates, tracking of expiration dates, their state-by-state logic, and even a customer-facing guided experience. So we're going to help you ensure that you're collecting the correct documentation, tracking that documentation, and providing you an audit-ready solution with easy reporting to make sure that your exemption certificate process is up to snuff. All right, Scott.
Okay.
Back over to you.
Yeah, no, it's I used to, so for the 10 years that I ran South Dakota sales tax, I would, and thank you, Thomas, it reminded me of that 10-year period. I would, if we truly would be asked by the legislature to raise more money. They didn't want to raise taxes. They needed more money. They would come to us and they'd say, if I give you $100,000, remember this a long time ago, and you hire 3 new auditors, in those days you could hire 3 auditors for $100,000, could you give me $5 million? And then we said, no, but if you give me 18 months, I can give you 3.5. Give me 36 months, I can give you $5 million. And so, and at that point in time, we would probably be paying that auditor $45,000 a year, and they'd be producing almost $2 million a year in audit assessments. It's all use tax, and it's still a use tax. It's even in the old days, it wasn't all that prevalent for someone to find a calculation error. And if you did, it was usually, it would balance out. You charge too much, you charge too little, over time it balanced out. Use tax, where you buy things from people that don't charge you sales tax, is forever. Even though we thought that would go away with the Wayfair decision in 2018, it's still the #1 way that states raise money in audits. We call them sales and use tax audits. They're really use tax audits, because they're looking for people that you buy something from that didn't charge you sales tax, and they're going to assess you that tax. They may eventually find that person and get them licensed and make that person charge you sales tax the next time, but they're going to start that conversation with you. So surprising sales tax exemptions, this is, it's one of the areas that the streamlined sales tax did not attempt to make simple or uniform was manufacturing. The way states treat manufacturing is so disparate. There is so little in common that it would be virtually impossible. You'd have to start over if you're going to do it nationwide. And nobody had the patience to start over on something like that. The predominant way of looking at manufacturing is that it has to be used in the manufacturing process, and it has to be at least a majority of its value is used in the manufacturing process. It's easier actually in actual manufacturing because things are pretty straightforward. You don't buy a piece of manufacturing equipment and that you then put in your CEO's desk and they use it for something entirely different than the manufacturing purpose. That isn't that common. It's rarely common. Where it's much more common is in agriculture. Farmers get audited and are often assessed use tax because they're manufacturers, and their manufacturing exemption is very different, not because the exemption itself is different, but because the products that they buy for agricultural purposes have multiple purposes. It's not some big manufacturing machine that sits on the floor of a manufacturing plant. This is something you drive around. I've seen audits where the auditor would assess a farmer use tax on a scoop shovel when the farmer made the mistake of saying, yes, I use that scoop shovel to shovel snow. You buy a scoop shovel to shovel grain. You're going to use a scoop shovel to shovel the snow. And so they get caught all the time because, if it's not used at least the majority of the time for agricultural purposes, it's not agricultural. Some interesting things that the states have done is most of them are trying to be better and more when it comes to manufacturing, because everybody wants to encourage manufacturing. So there's a lot of exemptions that exist today that didn't exist 15 years ago because there wasn't such a thing. They're expanding the manufacturing definitions to data centers. And I wouldn't personally call a data center manufacturing, but they're taking the same concept and and applying that to the kind of purchases that are necessary to create a data center. Research and development credits are very common. They get bounced around a lot because states don't really understand research and development. Just a second to talk about Louisiana. I said earlier that 2025 was one of the busiest sales tax years that I've ever seen. A lot of it was because of Louisiana. They wanted to make, I told you about the poor folks in West Virginia that think they could be Florida if they simply got rid of their income tax. Well, Louisiana thinks they could be Texas if they got rid of their income tax. And so their governor and legislature did a fairly good job of addressing the differences between Texas and Louisiana and a tax policy perspective by increasing the sales tax rate, because they needed to do that. They needed to increase the rate to raise taxes, to raise money to offset the taxes they were going to repeal. And the taxes they repealed are the taxes that Texas doesn't have. It's okay to have a sales tax because Texas has one. They have a very complicated local sales tax system like Texas does. And they're making effort to try to make the local sales tax look like the state sales tax. And it's very complicated, and it's going to take a long time to get it done. But they're actually making that, they're actually making some progress on that. But they had counted on a constitutional amendment that was put before the voters last month that would make some radical changes to their constitution and the way taxes are applied in the constitution and the way money is spent in the constitution as a way for them to facilitate the future changes they need to make to become Texas. And the people just said no. They said heck no. 65% of the people in Louisiana voted no on this constitutional amendment that the Texas legislature and governor think is necessary to fix their tax structure. So hard to say where this is going to go. Oh, and by the way, to make the local sales taxes look like the state sales tax, they made changes that resulted in every sales tax return in Louisiana have to be changed. And there are 72 sales tax returns in the state of Louisiana. There's 2 state returns, a multi-parish return, and then individual parish returns. Every one of them had to be changed effective January 31st, so we could file the January sales tax return in February, and many of them didn't get done. It was a complete mess. Retail delivery fees. This is something everybody needs to be paying attention to, because retail delivery fees are a new way of funding transportation. Oh, by the way, Mississippi, and the way we have historically paid for transportation projects in the United States is with a tax on gasoline and tax on diesel fuel. Well, as vehicles have become more fuel efficient or they become electric, that has become an unreliable source of revenue to fund an ever-growing infrastructure need and an ever increasingly more expensive infrastructure need. And so states are trying to look for alternative ways of raising money to do that. Oregon has a mileage fee that you pay every year, which is in lieu of your annual registration fee. Colorado and Minnesota implemented a thing called a retail delivery fee, which is exactly what it sounds like, a fee imposed upon retailers who ship products inside those 2 states. So you're a multi-state retailer and you have a customer in Colorado, you sell them something and you ship it to them, you have to charge them this fee. Unless you don't want to charge them the fee, which means you can eat the fee, you can pay the fee yourself out of your own pocket. But if you want to charge them the fee, you have to literally charge them the fee. You have to put it on the invoice. It has to say retail delivery fee 29 cents. Or in the case of Minnesota, retail delivery fee 50 cents. And if you're in Colorado, you file 2 returns a month because they didn't amend their sales tax return to allow you to remit this retail delivery fee on the sales tax return. They created a new return. So now you have to file 2 returns a month in Colorado. Minnesota, they at least amended their sales tax return and put the fee on the sales tax return. But then they did something really odd. They needed to raise X amount of money. And the only way they could raise X amount of money was to include clothing in the tax base. Clothing is not subject to sales tax in Minnesota. The vast majority of people outside of Minnesota that sell clothing into Minnesota never had a sales tax license because what they sold wasn't taxable. Therefore, no need to have a license in the first place. So when Minnesota imposed the retail delivery fee on sales tax exempt clothing, everybody who was selling clothes had to get a sales tax license because you remit this on the sales tax return. So we have a lot of people out there that collect no sales tax whatsoever on this clothing they sell in Minnesota, but collect a 50-cent per invoice retail delivery fee. It's extremely complicated. And often the cost of administering the tax is far in excess of the tax that gets remitted. But what's important about this is that just about every other state in the country is having a conversation about doing something very similar. Every state in the country has a need for more revenue to fund their highways. Earlier I talked about the governor of Mississippi thinking that they would be Florida if they got rid of their income tax. Well, in addition to signing legislation to lower their income tax and effectively, in their mind, hopefully repeal it in 10 years, they also raised their tax on gasoline. So they have a need to fund their highways at the same time as they're trying to find money to get rid of their income tax. These things are very complicated. What do I have here? I think I went over this slide. Oh yes, it took everybody a long time to adapt to this, including us. We weren't slow to get our system acclimated to this, but we weren't the first people to get it done. Okay, what else do we have here? Oh, this one here, I include this slide mostly because I wanted to emphasize how busy January 1, 2025 was. But it dawned on me that this is every month. Every month brings a chance for new or changes to local taxes. Like I said, there's 13,000 local governments with a sales tax, and that's just the sales tax. There's probably another 8,000 have a lodging tax or a meals and beverage tax. There's probably 800 or 900 around the country that have an income tax. And they all change. I told you that even if the rates never change in these local governments, their boundaries change all the time. Well, on January 1 of this year, we had one state rate change, Louisiana. We had 159 new local taxes, repeal taxes or rate changes in 24 different states. So if imagine you're trying to do this thing from your home office and you're trying to figure out what sales tax rate do I charge? How do I know that the boundaries of Cheyenne, Wyoming have or have not changed? Thankfully, you don't have to worry about Cheyenne, Wyoming, because that sales tax is based upon the county, and county boundaries never change. But if you didn't know that about Wyoming, you wouldn't know that you don't care if what the Cheyenne and Wyoming's boundaries ever change. You just need to know what the sales tax rate is in the county where Cheyenne, Wyoming is located. That's not the case in Rapid City, South Dakota, or Denver, Colorado. Those boundaries change all the time. So on January 1, we had 71 new taxes, either the creation of new local governments, which is usually a special purpose district, or some local government that had the right to have a tax, but just never got around to having one. 74 increases to existing taxes, 11 decreases to existing taxes, and then 3 repealed existing taxes. And the 3 that repealed were special taxing jurisdictions. The legislature allowed a group of people to create a jurisdiction and impose a sales tax to fund some special project. When the special project is paid for, the tax goes away. We had that happen in some city in Colorado in February. There was a city, and I can't think of the name of the monument or something like monument. This city had a special sales tax rate that was in effect to fund a very specific thing. And on the 11th day of February, they had raised enough money. So they repealed that tax on the 11th day of February. They gave, the only notice that anybody had was that it happened to be published in the paper. If you didn't read that city's paper, you didn't have somebody like Avalara helping you, you'd probably still be charging the sales tax in that little town in Colorado. It's mind-numbingly complicated. Okay, Thomas.
All right, why you need Avalara? I think we maybe gave a few good reasons. Scott, appreciate the help in the presentation. If this is the first time you've been exposed to Avalara, we provide global tax compliance for the Infor network, and that includes CloudSuite Distribution and SXC. So we integrate seamlessly to your ERP. So to address a lot of things we talked about today, for those taxable transactions and individual product taxability at the jurisdictional level, zip codes don't work. You need a solution like AvaTax to help you with that accurate calculation and all the reporting that comes with it. That's going to drive efficiency, help you stay compliant, reduce risk, and we scale with your business. As your nexus expands, your responsibilities grow, you'll have a solution in place that allows your business to continue on into the future and to continue growing.
That's great. Thomas, Scott, really good session. We do have one question. Mike asked a few minutes ago, we are in Colorado and use an add-on to handle the RDF fee. Is there a way for us to handle this now in Avitex?
There is, and we actually have a Knowledge Center article that details what you'd need to do, but Avitex does support it. And Shane, I'll be sure to get you a link to that information on how we support that.
Great. Any other questions? Drop them in the Q&A. We'll hang around here for a minute or so, but really good, informative session. For those, again, that were not able to attend, this will be downloaded and then uploaded to Central Data TV, so you can share that for others to stream at their convenience. Really good session today, guys. Appreciate the time. I don't see any other comments coming in, so we will let everyone have a few minutes back in their day. Thank you so much.
Thank you.
Thanks, Shane.